Hello everyone. This is in days 101 test your knowledge questions. Very easy set of questions. Once the points are clear, it is easy. But evening we may not get enough time to go through this. So question number 1. Company A intends to restate its past business combinations with effect from 30th June 2010. Being a date prior to transition date. If business combinations are restated, whether certain other exemptions such as deemed cost exemption for PPE can be adopted? First of all, what is deemed cost exemption? If 1st April 2011, just a random date, if this is the date of transition, what do you mean by deemed cost exemption? Deemed cost exemption means on 31st March 2011, as per previous gap, what were the old carrying values that you can simply take over as deemed cost? Or 1st April 2011's fair value of assets and liabilities, that is the deemed cost. Can you adopt or can you take over this 31st March 2011 gap values or 1st April 2011's fair value if you plan to restate a business combination prior to the date of transition? Answer is, for the same asset, no. The assets which were taken over in the course of business combination, for such assets, you cannot avail deemed cost exemption. Why? Because of the same reason. If you have restated business combination, what do you mean by restating business combination? All the assets and liabilities which were taken over from the books of acquiry will be measured at the fair value on that date, and for that asset we'll be charging depreciation, which need not be the same as the old carrying value or the fair value on the date of transition. So both cannot be availed. Deemed cost exemption on the same assets cannot be availed if you restate business combination. I hope it's okay. Simple. Class when we written the points, example. Then, question number 2. X Limited was using cost model for PPE till 31st March 2012 under previous gap. Okay. The Ind AS becomes applicable to the company for the financial year beginning 1st April 2012. 1st April 2011, that is the date of transition. Is it the date of transition? So Ind AS becomes applicable from 1st April 2012. So 2012-13 is the year for which you will prepare your first Ind AS financial statements. Yes. Previous year will be 11-12. So the transition date is 1st April 2011. This is the first Ind AS financial statements date, correct. On 1st April 2011, that is the date of transition to Ind AS. It used fair value as the deemed cost in respect of PPE. Yeah, that's correct. X Limited wants to follow revaluation model as its accounting policy in respect of PPE for the first annual Ind AS financial statements. Whether the use of fair value as deemed cost on the date of transition and use of revaluation model in the first annual Ind AS financial statements would amount to change in accounting policy? No. Taking fair value on the date of transition and subsequently if you follow revaluation model, will it amount to change in accounting policy? See, both are same. Fair value is also revalued figure. Otherwise also, this deemed cost, when you go through the answer, you will understand. Answer nokumba namukku manasilavum. Deemed cost nalla vilikane. Cost nalloru revaluation model shift aano idu ennaanu basically uddeshikkunna question. And I'll answer anna vaayikam. Answer oru clarity ku endha evada koduthekana. We need to read only this line. Since the entity is using fair value at the transition date as well as in the first Ind AS financial statements, there is no change in accounting policy. Mere use of the term deemed cost would not mean that there is a change in accounting policy. Very basic question. Very basic question. ഇതൊക്കെ നമുക്ക് ഈസി ആയിട്ട് സ്കിപ്പ് ചെയ്യായിരുന്നു actually. Okay, third one. Y Limited is a first time adopter of Ind AS. Okay, the date of transition is 1st April 2015. On 1st April 2010, it obtained a 7-year US dollar loan. Okay, 7-year US dollar 1 lakh loan, foreign currency loan. It has been exercising the option provided in paragraph 4646A of AS11. That also we have discussed. If the loan is taken for depreciable asset, the foreign fluctuations, exchange fluctuations can be adjusted to the carrying value of asset and depreciate it over the remaining useful life. As a legal, if it is used, if it is loan is taken for some other purpose, we form a new account called FCMITD to accumulate the fluctuations. Shariana. It has been exercising the option in paragraph 4646A of AS11 and has been amortizing the exchange difference in respect of loan over the balance period of such loan. On the date of transition to Ind AS, Y Limited wants to discontinue the accounting policy as per previous GAAP and follow the requirements of Ind AS 21. You can come with the old memories till that loan is repaid. Or fresh Ind AS 21, resetting the reserve balance to 0. So what the management plans to do, Y Limited wants to discontinue the accounting policy and follow the requirements of Ind AS 21 with respect to recognition of foreign exchange differences. Whether the company is permitted to do so, just write the provision of Ind AS 101. Optional exemption, you get two options under continuing old practices with old accounts till that loan is repaid, or resetting the balance to 0. Hence, the company can continue with can apply the provisions of Ind AS 21 in the new financial statements. Okay. Question number 4. A company has chosen to elect deemed cost exemption in accordance with Ind AS 101. Okay. However, it does not wish to continue with its existing policy of capitalizing exchange fluctuation on long-term foreign currency monetary item to PPE. That is, it does not want to elect the exemption available as per Ind AS 101. In such a case, how would the company be required to adjust foreign exchange fluctuations already capitalized to PPE under previous GAAP? Okay. For GAAP, see, as per previous GAAP, property, plant and equipment, to the cost of property, plant and equipment, the foreign currency fluctuations were capitalized originally, but the company doesn't want to continue that practice. So if the company is not continuing the practice, do you need to reverse the losses which were already adjusted to PPE, which were already capitalized to PPE? No need. If you don't want to continue with old practice, okay, well and good. But for PPE, deemed cost exemption can be availed. Nothing wrong. Till yesterday, whatever you were doing with regard to your PPE, that old carrying value is accepted as per Ind AS 101 in financial statements. So other mistake value added, value deduct, whatever previous gap carrying value is accepted. Other any changes and you can continue with new provisions of Ind AS 21 with regard to foreign exchange fluctuations. And a harmonious blending of both are possible. Okay, so clear P1, 2, 3, 4. Doubt please do send a audio note to my WhatsApp number. I'll clarify it. Please don't hesitate. Personal and the clarify the anola. This is a question added in May 21 paper. Problem, I mean, numerical, and this is important. I consider this as an important one. Please listen. XYZ Private Limited is a company registered under Companies Act. Okay. Following accounting standard notified under Companies Accounting Standard Rules 2006. Okay. Company has decided to voluntarily adopt Ind AS with effect from 1st April 2012 with a transition date of 1st April 2011. Okay, Sammachu. X Limited is a company, 1st April 2012 onwards, they are starting Ind AS. So transition date will be 1st April 2011. Okay. The company has one wholly owned subsidiary and one joint venture which are into manufacturing of automobile parts. Oh, a subsidiary under 110 consolidation, joint venture under Ind AS 28 consolidation equity method. They have already prepared consolidated financial statements as per Indian GAAP. Consolidated financial statements, share capital, reserves, long-term borrowing provisions, liability, trade payable, short-term provisions. PP, goodwill on consolidation of subsidiary and joint venture. Investment property, long-term loans and advances, investments, current assets. Okay. Additional information. Company has entered into a joint arrangement by acquiring 50% of equity shares of ABC Private Limited. Okay. So there is a joint venture entity. 50% are share. Presently, the same has been accounted as per proportionate consolidation method. See, proportionate consolidation method as per AS 27, which we have not studied. Either instead of number full consolidation on 100% of assets take over. In the NCA, proportionate consolidation means all assets in them 50%. The joint venture entity ABC Private Limited, all assets in them 50% take over. This consolidation as per accounting standard. Here, consolidation of joint venture, we follow what? Equity method. Number assets and liabilities take over. Illa, we will not take over the assets and liabilities. Okay. So the proportionate share of assets and liabilities of ABC Private Limited. This balance sheet include assets and liabilities. Balance sheet, the amounts are given to you. The investment is in the nature of joint venture as per Ind AS 111. The company has approached you to advise and suggest the accounting adjustments which are required to be made in the opening balance sheet. So, question manslaya. Ivada, namada company, Ind AS 111 joint arrangements applicable aanu paranjittunde. Nammal adonnum vishwasikkaruthu. This company is having investments in ABC Private Limited, which means is that joint venture is just a JO or JV? Is a joint venture JO or JV? Number point is it an separate legal entity? Separate legal entity? The ABC Private Limited is a separate legal entity. Then it is a JV. For which Ind AS 28 is applicable. Ind AS 28 is applicable. Therefore, I have to follow equity method and do the accounting. In the gym, how do I prepare? The point is, this is previous gap. This is the previous gap financials. This is the previous gap. We don't want this. We want transition date and preparing. So, this date. Okay. Will there be any change in share capital? Yeah, reserves and surplus. Wait. That's the main assets and liabilities. I need to deduct. From this assets and liabilities, we need to deduct the assets and liabilities of joint venture entity. Yes or no? We need to remove, we need to eliminate the assets and liabilities of joint venture entity. And the main problem here, there is a goodwill on consolidation of subsidiary and joint venture. So this is a goodwill both on subsidiary and joint venture. So how much is joint venture goodwill? Joint venture and goodwill calculate. See, the question is the answer is very simple. So So the first step, we will identify what is the goodwill calculate and cost of investments another pre-acquisition profits, share capital, share. So either data, either investment, either data, another pre-acquisition profits. So what the study material has done is, if such a question comes, you are supposed to do the same thing. Idana total assets. Let me take 1200 plus 405 plus 280 plus 50, 1935. 1935 minus 75 minus 35, 1825. 1825 is the net proportionate share of net assets of joint venture entity. Yes or no? E balance sheet joint venture entity assets 1825 net assets. Net assets 1825. Okay. Now 1507 is the goodwill. 1507 is the goodwill. We are going to find out E 1507 etrayana subsidiary goodwill, etrayana joint venture goodwill by just doing proportionate calculation. Proportionate calculation, yes. So just have a look. We will find out how much is the total net assets of so just calculation of proportionate goodwill share of joint venture. So we'll take the total net assets of the total net assets as per consolidated balance sheet 23,137. So how do you arrive the total net assets? Total net assets stay from the balance sheet. Total net worth. You take all the assets minus liabilities, you will get 23,137. So that is what the calculation given. Total net assets 23,137. Sherikim calculation parayanengil goodwill include cheyerudhu. Goodwill include cheyerudhu. Goodwill exclude edittu vedayirunnu total net assets calculate. Okay, but they have taken it. The exam. So we are just following the study material how to do this steps. So because it is there in test your knowledge, so total net assets of group, total net assets of the group 23,137. Okay, total net assets of joint venture entity, it was 1825. Goodwill 1507. So 1507 into 1825 divided by 23,137. 118.869. So rounded to 119 approximately. So goodwill related to goodwill on consolidation of subsidiary and 1507 divided by 23,137 into 1. Now what they have done? What they have done is from the balance sheet, they have eliminated all these assets and liabilities. We have eliminated from the transition date balance sheet. First PPE. We took PPE double 288. From that 1,200. Deduct because consolidation illalo. Joint venture assets. From investment property, there is nothing. Goodwill. From total goodwill, we eliminated 119. Long-term loans and advances. This we will discuss 1944. Then from other assets 280 deducted, 50 deducted. Share capital no adjustment, no adjustment. Trade payables 75 and 35 adjusted. So instead of showing the net assets, the same net assets, we have taken 1825 as the net assets of joint venture. So 1825 plus 119. is what? 1944, which came as investments in joint venture, which means net asset. See, when we were doing Ind AS 28, I used to tell you net effect on investments. So this 1944 will appear in the balance sheet asset side. But basically, what did you do? This is a very easy question. This joint venture assets and liabilities included. So the joint venture assets and liabilities are separated. But goodwill. Goodwill goodwill proportionate break. In the absence of information, goodwill proportionate break. How you did that? We took the total net assets of the entity, total net assets of joint venture, and we divided proportionate goodwill identified. Okay, proportionate goodwill identified. Then strictly speaking, goodwill should not be taken when you break it. So goodwill include the net assets calculate goodwill break goodwill divide. Then the net effect of that assets and liabilities is shown as investments. Did you understand? It's effective. Lame excuses. It all depends on our attitude. It all depends. But we normally do this test your knowledge discussions. That's why we are doing right now. Illustration 6. Question number 6. Question number 6 is easy. In the question number 6. Mathur India Private Limited has to present its first financials under Ind AS for the year ended 31st March 2013. The transition date is 1st April 2011. In the check the transition date 12, 13, 11, 12. So 1st April 2011 is the transition date. The following adjustments were made upon transition to Ind AS. The following adjustments were made. In the can adjustments, the company opted to fair value its land on its date of transition. The fair value of land on 1st April 2011 was 10 crores. Carrying value is 4.5 crores. Can you value it at fair value? Yes. You take it to fair value. The difference you take to retained earnings. But previous problem differences because or investment vannu debit, liabilities debit vannu, assets credit. Net effect is same. Net assets the amount investment side. So there is no difference in the previous question. If up on the figure will take to retained earnings. Okay. The company has recognized a provision for proposed dividend 60 lakhs and related DDT 18 lakhs during the year ended 31st March 2011. It was written back as on opening balance sheet date. So what is the question? What is the balance of equity? Show reconciliation. Okay. Total 78 lakhs were written back. So it is dividend payable debit, dividend distribution tax debit to retained earnings. Okay. The company fair values its investments in equity shares on the date of transaction. Increase on account of fair valuation of share is 75 lakhs. Investment to retained earnings. You can take to P&L. Retained earnings, you can show it to P&L also, but safely to retained earnings. The company has equity share capital of 80 and redeemable preference share capital of 25 crores. Equity share capital will be shown under equity, but redeemable preference share capital will be shown under liability. Okay. The reserves and surplus as on 1st April 2011, before transition to Ind AS, was 95 crores, representing 40 crores of general reserve, 5 crores of capital reserve acquired out of business combination, and balance in retained earnings. So before the transition, the figures were, one second, we had for general reserve, we already had 40, capital reserve, we already have 5, and balance in retained earnings 50. Okay. The company identified the preference shares were in the nature of financial liabilities. What is the balance of total equity? Equity and other equity as on 1st April 2011 after transition to Ind AS. How easy it is. Even നമ്മൾ ആദ്യത്തെ end തൊട്ട് നമ്മൾ നോക്കണം. What is the revised retained earnings balance? Equity, only equity share capital will come. Sure reconciliation between total equity as per AS and Ind AS. Ignore deferred tax impact. Thanks a lot. Deferred tax impact illa. So in that end 6. Much self-manageable. Share capital 80. Other equity, general reserve already 40. Capital reserve 5. Retained earnings 50 ana. But increase in value of land. Derecognition of financial proposed dividend. Yes. Increase in the value of investment. Itralli ullu. What was the equity as per accounting standard? One second. What was the equity as per accounting standard? Equity as per accounting standard, equity share capital, preference share capital, reserves and surplus. What are the adjustments? Preference share capital ne eduthu kalanju, pinne korchu reserves extra vannu because of the change in values to Ind AS. So this we have eliminated. Then proposed dividend, these two changes. Okay. Then the last question. ABC Limited is a government company and is the first time adopter of Ind AS. Okay. As per the previous gap, the contributions received by ABC from government, which holds 100% shareholding in ABC, which is in the nature of promoter's contribution, have been recognized in capital reserve and treated as part of shareholders' funds in accordance with AS 12. നമ്മൾ Ind AS 20 എടുക്കുമ്പോൾ പറയാറുണ്ടായിരുന്നു promoters contribution എന്നുള്ളൊരു കോൺസെപ്റ്റ് Ind AS 20 ഇല്ല. Promoters contribution as per accounting standard will be taken to capital reserve. Other. State whether accounting treatment of grants in the nature of promoters contribution as per AS 12 is also permitted. We have not studied. Continue with all the practice we have not seen. Under Ind AS 20, accounting for government grants and disclosure of government assistance. If not, then what will be the accounting treatment of such grants recognized in capital reserve as per previous gap on the date of transition to Ind AS? So give me a moment. Okay, I hope you understood that question. Capital reserve already oru government grant kadappundu. So can I continue with that capital reserve? Government grant amount adupole and promoters contribution, can I continue in the first Ind AS financial statements? What is the answer? No, we have not studied such a treatment as per Ind AS 20 or Ind AS 101. Angaru exception onnu njangal kandilla. So what is the answer they have written? First time adoption. So first of all, as per Ind AS 20, all the grants received will be taken to statement of P&L. It will be taken to statement of P&L, where it is concluded that the contributions are in the nature of government grant as per Ind AS 20. First time adoption. Ind AS 20 requires all grants to be recognized as income on a systematic basis. Okay. Unlike in AS 12, Ind AS 20 requires grant. Okay, no. Then, so here, what is the answer? The answer is recognize. Anyway, it cannot be shown under capital reserve. Then what else we'll do? It should be transferred to P&L. It should be transferred to P&L. P&L like transfer. As per Ind AS, you need to write only this much. As per Ind AS 101, recognize all assets and liabilities as per Ind AS. Derecognize assets and liabilities not required as per Ind AS. Reclassify and remeasure. The points, 4 points. Accordingly, as per the above requirements in the given case, contributions recognized in capital reserve should be transferred to appropriate category under other equity on the date of transition. Only one category is there, that is statement of P&L. Okay, so these are the 7 questions in test your knowledge. Then 2 very good questions in nalla questions chedu. Yan idu chodikkum nakke paranju 2 questions. Idana total Ind AS 101 lolla investment. What you should do is read the notes carefully. If possible, read the starting illustrations. Korch illustrations on the starting illustrations vaikkanam. Pinni problems okke ee video kanda, I hope it is almost at 80% done. 20% എന്തായാലും effect അവിടെ നമ്മൾ ഇരുന്ന് എഴുതി പഠിക്കുകയോ എന്താ പറയാ sentences ഒക്കെ capture ഒക്കെ ആയിട്ട് ചെയ്യണം. But this is what we have taken, maybe 3.5 hours for Ind AS 101. നിങ്ങൾക്ക് ഒരു 1.5 hours വെച്ച് അത് finish ചെയ്യാവുന്നതേ ഉള്ളൂ. Okay, so that's all.